everybody. My name is Lexi. I just figured we would get started since we are accommodating for some different time zones and want you guys to get your Thursday night started. I'm with the PR team at QuantConnect. I just want to thank you guys all for being here. We're planning on doing one of these meetups about once a month. So we'll be kind of bouncing around, hopefully, to different time zones to accommodate for other people. But for now, we will have about 4 people presenting on their strategies that they've been working on. Then we can have a little bit of a Q&A after that, so you guys can get a chance to talk about their strategies and maybe talk about what you've been working on. And then after everybody's done presenting, we will have a little open mic session so you guys can get a chance to share what you've been working on as well. So first we have Jovad, who's going to present to us, and I'll let him get to that to present his presentation.
Hey everyone, thank you for having me here. Just a quick disclaimer, there's a dog, so if it gets loud in the background, I'm sorry. So I'll share my screen, kind of show what I've been working on recently. So, over the past couple of days, I ran into this website called SafeGraph, and essentially you could buy data from here. And they have this this cool discount going on because of COVID. You can get up to $500 worth of free data, and essentially it's this pretty large spreadsheet of foot traffic and POI data in stores. And I decided to kind of go for the home improvement retail businesses as they're more like brick and mortar stores. So I chose Home Depot and Lowe's. So when you get this data, it's kind of unstructured. It's quite expansive. And over here we have visits by day in kind of a string array. And there's a lot of cool data here, but today we're just going to be really focusing on the visits by day here. And this is for each individual store. The first part of the array is day 1, and the last one is the end of the month. So I first kind of cleaned up data in a Jupyter notebook. I'll be sharing all this within the community once it's done, so hopefully everyone can kind of learn from this or expand upon it. So before getting to actually what the algorithm does, we need to clean up this data and get it ready to pump into QuantConnect. So we kind of import all of our packages here and libraries. We have, and then so we download the CSV. It's called patterns.csv, and we want to focus on getting visits by day, raw visit counts, and put that into a data frame. So we do that, and it comes out right here. And as we move on, we're just kind of filtering everything out. So this actual array is one entire string, so it's not a real array. So we need to split everything by commas and remove the brackets. And we just kind of clean everything up, sort it into an array, and so it comes out. The top bar or the columns are the store number. So it says that we have 1,955 stores, but a lot of these numbers skip. So you see 12, 14. I don't know why it does that, but moving on. It's only 30 days of data, so not too much, but it's enough to get started. And here we kind of plot all the data, but put it on the same scale here. And as you can see, there are some outliers, but generally they all follow the same trend. Now, again, this is only 1 month, so there's not too much insight that we can get out of this. We can't see if the actual foot traffic in stores has an effect on stock price, but this just kind of gives us an idea of how the data is formatted. And from there, we want to sum. So I was originally going to use machine learning to create like another 15 days, like 15 days into the future, and see, 15 days from now, what's the foot traffic going to be like, and can we invest into future patterns? But here I decided to take the aggregate of, or the sum of all visits per day for Home Depot and bring it into one data frame. I'll just show you the entire data frame. So this is kind of the final data frame, 30 days of summed up data. And we export it to a CSV, and the reason why we do that is we're just going to work with the data we have. But one thing I am trying to improve upon this algorithm is use machine learning to, determine, like right now it only has 30 days of data. Can I extend this to 45 days of data with 15 days being predicted? This is the current model. Just kind of testing it to see if a decision tree works. Now, hopefully I can make this work and post it on the community. But for now, we're just going to dive into QuantConnect here. So we're only going to look at Home Depot, although Lowe's is in the data set. I only pumped in Home Depot just to make it more simple. And so we import the data, risk management at 5% drawdown or trailing stop loss. And the reason why we do this is we want to drop the days in the data frame that are not trading days. This might be a little bit counterintuitive, but does require a little bit of extra coding to, let's say, analyze the weekend. But we just drop all the trading days. And essentially the goal is to plot a simple moving average of the foot traffic and then get the slope of the simple moving average. And if the slope is trending downward, or the slope is negative, then we short. The slope is positive, we long. And the idea is that if we had a much larger data set, let's say all the businesses within the home building retail section with, let's say, 2 years of data, closed data for every visits per day, we can then combine it and kind of determine the general trajectory of the industry growth. So then we can trade the home builders ETF. That's the main idea, but that data can be quite expensive. So yeah, moving forward here, we just call a method to make it trade every day. We run through count. Count is essentially just to make sure that the data we're analyzing is on the current day that we're trading. We make an SMA, put it into a rolling window which was declared up here, and then calculate slope. And then here we trade, and we only take we're only 40% leveraged. We don't want to have too large of a leverage position. Now, the back test looks great, but this is only 1 month of data, 1 month of trading, so this can be quite overfit. Home Depot may have just done really well. But yeah, this is kind of what I've been working on recently. Anyone have any questions, insights, or how we can make this better, or any pitfalls?
Have you just tested it against buy and hold, just buy and hold Home Depot?
I have not.
Okay.
Try.
Yeah, you could just do something like self.send benchmark or something, right? I mean, it depends on how long it takes to run, though. I mean,
I'll just do it.
Oh, and I'm sorry, I didn't hear the name of the website.
It's called Safe Graph. If you go on the website and you click right up here, it brings you to kind of like a map of COVID. And then if you scroll down a little bit, you can, right here, science and data. It's up to $500 of credit on their website. It really only gets you about a month worth of data for around 1 to 2 companies in terms of foot traffic. It's usually 10 cents per row, which is quite expensive. But
Well, it's interesting. I guess, as we look to see when people start going back to stores again, that's it's always a good indicator.
Yeah, agreed. Now, one thing I don't know about the data, I don't know if it comes in after the month is over or if it's real time. You could probably get it somewhat close to real time if you were to reach out to them and kind of work out like a special deal. But then again, it is kind of expensive. I guess.
Does anyone have any more questions about Joe Bad's strategy or anything like that?
Nope. Well, thank you.
Nope. Okay.
For present. Yeah, you can go, Lexi.
Okay, cool. I was just gonna introduce Schiller, who will be presenting next. He's actually an intern with us. He's working on a few strategies as well. So I'll go ahead and let him jump in there. Thanks, Joe Bad.
Okay, I'll share my screen. Can everyone see it? Wait, can you guys see it? Let me see the chat.
Yep.
Okay. So recently I've been working on like this part of like, I can't see the chat. Oh, there it is. This is part of like the stuff I make for the this is part of the strategies I make for the strategy library. And this is paper, SVR wavelet. It's basically like combining wavelet and like support vector regression in order to predict time series. So so here I have like, when I'm coding, I usually put all my stuff in the Colab notebook before I copy it over. Like, there's a built-in research, but to be honest, sometimes I don't use it. Unless I need like actual data, then I go in there. So, so what it does is it first, like, I'll just go. So it takes the data and it like decomposes it into several levels using discrete wavelet transform. So I have this forecast method. So I just specified the wavelet I want to use. So what I do is I decompose it into multiple levels and then I denoise each wavelet. So let me just like, let's just see what this looks like all this stuff. So I've generated some synthetic data. It's just, yeah, here it is. It's just a sine wave with a little noise added to it. So what you can see here is we had the original wave here. I mean, no, the original time series here. And what I've done is decompose it into like multiple levels. And then each one is denoised. If you can see here, it's a lot less noisy, each of these. And like it's denoised using thresholding. And so what that basically does is it like thresholds the values so that like they become smaller. So you can see all these values are like the magnitude is smaller. It looks a lot less noisy. And so then what I do is I like pass each of the components into like a SVM model or a support or SVR specifically because it's a regression problem, and then like it predicts each of these, and then after that I'll recombine it. So how, like, here, I have this partition array like thing here. Let's see what that is. Okay, so what it does is it takes these two variables. It takes the first, so this is the window length. So we have these two, so you can see here these two, and then we can take, and then I also take the one value right after these two values and I put it here. And then I take these two, it's over here, and then here. So I'm using, so with my SVM model, what I do is I take, I take these values to predict this value. So I just like take historic past data to predict one time step in ahead, and I just pass them to my SVM model. And then after I pass, so like you can see here. Well, it's commented out right now. Yeah, let's see the SVM forecast. So I partitioned the data as you saw earlier. Oh, I also use grid search, which basically like uses these at like iterates through all of these and like tests them out to see which one gives us the best SVM model or SVR model using grid search. I mean, no, yeah, grid search and cross, and it like evaluates it on this metric. And there's also a cross-fold validation. Hopefully you guys know what that means. And so what I do is I use this SVM model to predict one. So I forecast the value. I predict one time step into the future, the value one time step into the future. And that's like, if that sounds familiar, it's like very similar to like ARIMA models, or like, yeah, like ARIMA models where you put in some data and you forecast one time step into the future. Except of using a ARIMA model, I'm using a SVM model because the paper used SVM, well, SVR model. It's because the paper used it, SVR model. And so I've uncommented the SVR, the SVR prediction. So we have this here. Wait, no, not right. Actually, one second. Okay, so let's have it. So that's it predicting without the SVR. Okay, let's uncomment this. You can see that it's slightly different. And I think this prediction is better. Like, because like a sine wave, it looks like this. Like this goes up a little too early. So with our smoothing and our SVM model, we can slightly predict things better. Well, like in theory, it might not too well. It didn't work too well. Okay, so what I did is that I just like copy all this code into the SVM wavelet.py. It's basically the same thing. The only change is instead of returning like so here I returned the whole series so that I can plot it. But when we're forecasting, we just want the last value. And so I just return the last value here. And so in here, what I do is I just like initialize the model. I just feed in the historical data, warm it up with historical data, and just keep feeding in data. And at every time step, I just forecast into the future. I forecast into the future. And so, and then I calculate the percent change from like what the close is right now. And that percent change like will determine the portfolio allocation. We're using insight weighting model. And that what that allows us to do is allocate more to more of our portfolio to larger moves. And okay, so I already have a back test here. And it does okay, I guess. It's not the best. Probably needs a little more work, or just the idea can be scrapped entirely. Okay. Okay. As Lexi made, okay, now let me talk about like what it's like to be an intern at QuantConnect. So like part of what we do is interact with the community. If you guys look at this community support, or like just even look at the forum in general, you can see like me and like a bunch of a few other interns. Derek has been doing a lot of stuff. This is me here. This is Derek. This is the other intern. He's working part-time now, but that's me again. And a lot of like the there's a question. That's me right there. So part of it is what we do is we're very community facing, and what we do is help out users with any of their like algorithms, or if they're having any bugs, we help them to the best of ability. And then also there's what I personally do is develop algorithms like these. Like I take a paper, I convert it into a code for QuantConnect, and I turn it into paper, and then I like make a write-up, and then I convert all this into like HTML files. That's what I personally do. That's one thing you can do. Another thing you can do is work on the open source backtesting engine, or you can work on social media. So like you can honestly do anything as long as Jared approves, and that's basically what it's like to be an intern. I hope you guys learned something. Oh yeah, something I have to mention this. So for each of the components, once they're like forecasted at one point into the future, you have to recombine the waves. You have to recombine the components into like the wave. So this is recombine stuff together, so that you have an aggregate forecast of the SVM. Like you forecast each individual component, and when you could combine them together, reconstruct the wave. That's the aggregate. Okay. Let me know if you have any questions.
Does anybody have any questions about Schiller's algorithms, or about what he does, or anything like that?
Actually, I was wondering if, because I know there's, you know, probably one of the more popular methods in the same area is the local stationary time series method, where you take like local stationary wavelet sort of method, which I think is the most, I'd say the one, it's similar. I've seen it quite a few times. I haven't seen what Eve mentioned this time. But I was wondering if you've compared the two, or you know, looked into the other one as well. These do seem quite similar, and you know, it'd be interesting to compare and contrast between them.
I use discrete wavelet transform because it's the easiest to use, like with the API, the PyWT, the PyWavelets API. I chose to use discrete wavelet transform. I'm not really sure what local stationary wavelet. I haven't seen it before. I've seen like stationary wavelet transforms. I don't know if that's the same thing, but I use discrete. I could test it out. Yeah, to be honest, I'm not like an expert in wavelets. So.
Yeah, I think they're relatively similar. It's just yeah, this one's, I guess, you know, it takes smaller intervals, and then it calculates it for that local interval. The main difference, I guess, would be that this one, I wasn't sure if you mentioned this, but it's a regression onto a vector that you're fitting, like a linear regression. Or
what like?
For each.
Yeah, well, like what I meant, like It's not a regression. It's like, oh yeah, it is a regression, but it's using a support vector machine.
Oh, okay.
Yeah.
Yeah, I don't think I've heard of. I think I've heard of SVR, but not SVM. So I think I might be a bit confused there. But I think the main difference would be the one I mentioned earlier is it would take it towards you look at it more like a time series, like a stochastic sort of model. So it'd be interesting to compare between the two.
Yeah.
But
yeah.
I'll give that a try when you post this one. This one's pretty interesting.
Yeah. Hopefully I can get the pull request merged for my write-up, and then or I can just post the algorithm. Yeah, I'll just post it in the chat right now. Okay. You guys see it in the chat, that's the algorithm. So if you guys want it. It'll be also out soon, like when the write-up gets posted for this on the strategy library.
Also, all the people that are presenting, including Schiller, are on Slack, and we're very open and communicative with our community. So if you have any questions, you can always reach us in Slack. The public all page, people bring their problems there. It's pretty big community, 1,500 it looks like. So you can always reach us there. Does anybody have any other questions for Schiller before the next person? Oh, it looks like we have a question in the chat, Schiller.
Scott, how to trade the algo? What broker? This seems like a general QuantConnect question. So like to live trade it, is that what you're saying? Like how would I live trade the algorithm? Can you correct me if that's wrong? Okay, so here I can show you. Okay. So first, the first thing I'll do is go live. You have to have a pro account. I have a staff account. I have a pro staff account, and then I choose a broker here. Can you see? You guys can see my screen still, right?
Yeah, we can see it.
Okay, so well, first you have to go here, open project, go to the algorithm. Oops. There it is. And then the hop right here, this is go live, select brokerage. And Alpaca. I use Alpaca. You'd enter. I can't. So you'd enter your key here. You press next. And then you do like other stuff, and then there's like there's more steps to like just launch it live, and then that'll be it. Hopefully that answers your question. Feeding step took a run. I don't time how long. I didn't time how long it takes to run the.
Sorry. When you during your last back test, I guess that'd probably be the longest.
Oh, the back test duration? It's like about 7 minutes.
Oh wow, that's pretty fast.
I mean, like, yeah, the SVM doesn't. Yeah, there's only one variable, like the closing prices. Okay, Scott asked, can you switch between backtesting and live trading? Is what happens if you have a position already. From backtesting, like in it, like backtesting, you don't buy anything. Like, it's all virtual. Right? It's like, because like you can't buy something in the from the past. But if you're like talking about like having a position within your brokerage account already, it keeps track of it. Like, unless you're using like a virtual position like Bitcoin and USD, like that's not an actual pair. Like Forex, they're like actual pairs you buy and sell. But when it comes to Bitcoin, like they're virtual pairs. You buy Bitcoin and you buy USD. So like it doesn't keep track of like the BTC USD position. But like if you have a position, and if you like turn off your algorithm and just return it on, whatever holdings you had from your previous positions stays. Oh, Jared answered it, so it looks like I don't.
Okay, does anyone have any more questions for Schiller before we move on to the next presenter? Okay, like I said, that we can, they can all be reached in Slack if you should come up with any questions afterwards. And next presenting, thank you, Schiller, by the way, for presenting that for us. And next we will have Igor presenting on his strategy that he's been working on.
Hey everyone, can you hear me?
Yep.
Awesome. Let me share my screen. I have actually made a proper presentation just because it'll be simpler to talk about some things. Let's share the screen. So there we go. All right, so there is something called magic formula investing, which I'll talk about right now. So the background of it, it was released about 15 years ago in 2005 by a person named Joel Greenblatt. He runs QuantConnect hedge fund in the US. I don't know if you know about it, but basically it's a fundamental value strategy. You can read the book about why he believes in it and his returns from it, but they seem to be pretty impressive. So he includes the backtest or the results of the backtest there, and he has a website that he runs. You can go and check out the recommendations for free based on this strategy, so you can improve it. Sorry, so that you can implement it yourself or follow it. I guess most of it is to be followed offline. But I decided to kind of dive into it and explore sort of the fundamental side of QuantConnect. So right now we'll cover some terminology that'll be important for understanding how the strategy is constructed. So EBIT is earnings before interest and taxes. So think operating profit like sales minus cost of goods sold minus operating expenses. So what did your business actually earn, right, as part of its operations? Enterprise value, think about it as market value of the business. So definition of it is sum of all claims by all claimants or creditors. So these are your bonds, basically debt, and shareholders, so market cap. So it's more than if you just buy all stock, it's if you were to buy the entire business, how much you will pay for it. So next, net fixed assets is basically your like major assets like land, buildings, equipment, minus depreciation. So primarily for machinery equipment, but you add things like improvements usually to buildings. And working capital is your current assets. This is usually inventory. Essentially think about it as an inventory, let's say if you're in retail, but your current assets minus current liabilities. So things that's pretty liquid and that you usually churn. This is working capital allows you to basically operate the business normally. Depends on an industry. So using these parameters, you can construct earnings yield, which is EBIT divided by enterprise value. So how much money does your business make? And return on capital is how much money do you make based on your sort of assets that you put into it. So what this formula is, it's right in the book, step by step. You establish a market cap greater than 50 million. you exclude utility and financial stocks, and you do this because some of these metrics don't work for them in the same way. You exclude ADRs, so foreign companies, so basically you just trade US market. Then you determine the earnings yield, you determine the return on capital, and you rank companies based on these two metrics. It's implied that it's equally weighted them. So you first convert them to percentages. So this is the original wording in the book. What I did is I converted them to percentiles. And you'll see it in the algorithm. So the book suggests investing in 20 to 30. Sometimes you can see variations to invest into 50 or top 10, but we'll talk about it more as well. If you have a super large portfolio that you can't really buy all positions at once, you kind of stagger it over time. But basically, you rebalance it once a year, selling losers 1 week before the year end, and sell winners 1 week after the year end. So naturally, so tax harvesting for tax purposes. And you keep doing this for a period of time. So it's a pretty straightforward formula. What does it mean in QuantConnect terms? What I did is I set up daily resolution for my universe. These are the filters that I've set up. So the on schedule function doesn't allow you to do annual events, as far as I know. So I just did kind of daily checking, and once the December 25 hits, it kind of just trigger changes the variable to say, okay, now run this function. Just filter for, let's say, stocks that have fundamental data that have a price change, and then go into find selection. So this is where you do market cap, asset class, and ADR check. But then you calculate earning yield and return on capital. Then you rank the securities, and you select the top 30. So following the formula. Now, once that is done, it says that, okay, your kind of rebalancing is done, and it turns off that variable, so you don't run it until the next December 25. Now, this is December 25. Sometimes it runs, for example, on December 28, because this will be the next trading day. As long as it's before the new year, and this was pretty arbitrary. But when securities change, this is when I sell my losers. So if cost, it should be the other way around. If price below the cost, we'll sell the losers, and then do nothing until then. Then there's another variable that tracks the change of the year, so time year changes. Then we'll rebalance the entire portfolio using the set holdings and portfolio targets. So this is the implementation of the algorithm, and I'll show you the code in a bit. And I can share it with anyone as well, it's not a problem. The strategy results are not very impressive. So I put it against SPY. The strategy didn't perform well over 5 years, so I ran it from January 2015. There were definitely periods when, let's say, right at the end of 2019, when it definitely outperformed the market, but it doesn't seem to be so consistent as promised in the book. So the book covers, I think, 15 years or so, and ends at 2004, because the book was published in 2005. But there was a joke in these value investing forums, essentially, that the formula stopped working right after the book was published, which kind of makes sense. Alpha decay, everyone knows about it, and everyone's tried to take advantage of it. So many people kind of looked into different variations and alternatives, and just understanding the formula a little better. So this specific site, quantinvesting.com, I think did a pretty comprehensive write-up on it and did multiple tests, so I'll use them. I didn't run these tests myself. That website was running, so this OMXH, it's a European index, large cap index. But In this test, what they do is they select, so not just top 30, but they take securities from 4 percentiles, or 4 quantiles, so top 25, upper mid 25%, lower mid, and bottom 25%. And they just track performance, but they went for more original data set from 97 to 2010 and seeing how they perform. As you can see, it's interestingly enough that it's not the top tier that makes the most money by using this formula, but the second tier, so upper mid. There's a couple of kind of theories that you can explain it with. One is that everyone, by default, follows the top tier. So again, alpha decay. Another reason might be that the price for the top tier is low for a reason, or that they're not kind of valued appropriately for a reason, and that's why they underperform. So basically structural. But these ones, it's the second kind of echelon is where the actual mispricing occurs. So there's different variations that were studied as well, such as investing in different market caps instead of just 50 million. So they put them into quantiles as well, and they will show if you invested in like top quantile, second quantile, etc. I think this is a bit more interesting. The original formula uses 2 scores. Again, earnings yield and return on capital. Here they try other metrics that are similar in nature, and basically test them in the very similar way in investing. So using this metric and using quantiles of whatever selection you make. And I think the original book, I don't remember what it promised, but basically they included this price index, which is more of a momentum take on it, which yielded highest result. But earnings yield was also, I guess, pretty high, so not necessarily the lowest out of them all. Yeah, so it is just food for thought and what to do. So let me just show you the actual implementation here on QuantConnect. So this is the data. I didn't use any of the portfolio construction methods. I didn't think they were necessary here. So we do course selection. So again, once we hit the time, and there's this variable if the universe needs an update, I included this additional code to gracefully take care of when you first start investing, so that if you invested before, like in the first half a year, it will rebalance at the end of the first year. If you invested in the late part of the year, you will not rebalance. So this is just a course filter. In terms of the fine selection, it runs, so it's exactly as the formula says. You take 50 million, the sector is not in financials, not in utilities, and if it's not a depository receipt, so it's not ADR. You have 2 functions on calculate the earnings yield and return on capital. So for return on capital, I did go through the entire data library searching for fixed assets and the terms, and I think, okay. Then you calculate the rank. So there's this function that calculates the percentile based on, so the value within the list. You rank it. You do a bunch of filtering. I also included just with positive. Anyway, rank. There were a couple of iterations, so probably actually some of it is not optimal anymore in terms of logic, but then you take the top 30 with the filter. I did set up a couple of logs here, so you can see which securities were traded. what were the percentile scores. So again, equally weighting the scores is also one of the parameters that you can take, that you can manipulate. So you can reweigh essentially one of the parameters to be more valuable than another. So, and this is what it is that on security change, you just sell. Maybe that's why it didn't perform well. This is actually what I did. Let's fix that. Well, if cost greater than price, let's rerun it and see what happens. It shouldn't really matter, I think, because it's just tax harvesting. Yeah, and then when on data happens, when it's a new year, you basically. So I personally had a little problem here. I didn't have enough time yet to read the documentation regarding set holdings. I know there is this version of true that says that it will liquidate all other positions before purchasing new ones, and the expected behavior, I would think these two lines would be sufficient, but it started doing something funky and shorting positions for some reason. So I just included this liquidate function. So I just didn't have enough time to understand what it did. So on the first day of the year, I basically first liquidate everything and then I buy it again, which is not optimal, but I don't think it will drastically change the formula results. It doesn't run for too long, but anyway, I don't expect it will perform well again regardless. So there we go. Any questions about what it is, how it works? Why do we think it should work?
Oh, I was wondering actually, did you test it against the one that like the alpha on QuantConnect on the GitHub? I'm gonna link it in the chat there. So there's an alpha actually in the repo. So just lean algorithm Python alphas and Greenblatt, that one I just linked there. So this one I think is, yeah, so it's a QC algorithm with a very similar, right? Even like
okay, no, I haven't seen it actually.
Yeah, the coarse and fine selection sort of similar to yours, but yeah, it'd be interesting to test yours against this one. I think this one's used as a benchmark.
Mm-hmm.
So.
Yeah, interesting. No, I didn't know about this existence. I mean, I've seen the folder of alphas, but or maybe some algorithms, but no, it'll be interesting to test. You're right.
And as for the, you said you're having an issue with the with needing to sell and then rebuy. Perhaps
Mm-hmm.
look, maybe it might be something to do with on securities changed. Just to guess.
Mm-hmm.
Probably something in that area because you need to change the securities for it to work. Probably, probably it needs to look there. But yeah.
Yeah, I actually just finished coding it, like while polishing the bugs earlier today. So I was concentrating on this, not specifically on efficiencies, but no, thank you. Yeah, this is something, again, the area definitely that I would like to understand better that contributes to efficiency of execution. You're right.
But I do find it very interesting the way you implemented it. Especially since I guess one of the differences is going to be when you look at these alphas that you'll see on GitHub, a lot of them are making calls to the .NET environment, C# code that we can't really see what's going on as well as when you're doing it this way because it's all Pythonic. So I do like the way you've reconstructed it here.
All right, thank you. Yeah, but I'll take a look at it. It will be very interesting to see what's the right way. Or another way of doing it, let's put it this way. Mm-hmm.
Igor, thanks. Now you mentioned that you really like working with fundamental data. I know QuantConnect just released an update where you could pass the fundamental data into the alpha model. So it'd be pretty interesting to see, if you could apply some sort of, ML model or decision tree to maybe predict the next, kind of like all analyst ratings, let's say in like a CSV file, and then conduct some sort of analysis to determine, where do we see the direction of this company going in, and we could then pick our stocks based on that.
Yeah.
Just an idea. That's something.
Yeah, that's definitely like one of the areas that can be investigated for sure. Yeah, I mean the whole idea of this value investing is basically mean reversion, right? Is that, I mean, standard metric is PE, price divided by earnings, but price is sort of a reflection of this enterprise value because market cap is part of that equation. And as long as usually companies don't change their debt a lot, right? So it's kind of, well, there is a high correlation, let's put it this way, between PE, and normally you would say that PE would kind of revert back to where it should be for a company. So this is kind of the same idea of this value investing strategy. Yeah. All right.
Yeah, I just kind of want to say one more thing. So there's this cool strategy. It's basically taking on like a market-weighted ETF, such as like SPY or a different ETF, and conducting your own type of value analysis for each stock within the ETF.
Mm-hmm.
You can then see if the ETF is underweighted or undervalued or fairly valued, and it's very rarely undervalued, but there's usually some arbitrage opportunity to take. It was in like a Bloomberg quant webinar they had. It was I think it would be pretty interesting to apply, a valuation algorithm to possibly find some ETF arbitrage.
Yeah, one of the interesting ideas or thoughts, actually, I was just scrolling through this, and I had to dig through it a little bit. So when I was working with this fundamental data, so in the data library, so let me just take any one. Whoops. What did I do? So in the examples everywhere, it will say here, so find 1 month, but not every metric has a 1 month value in it. So if we actually go, so once you click on this link, you can go into a C code to find it, and you can go through like which metric it has, like 1 month, 2 months, 3 months. For income statement, I kind of sort of understand that you need a 12 months period. Balance sheet, so I need to go into research books to actually look at individual snapshots. But balance sheet it's snapshot, right? So I actually don't understand. If somebody knows, maybe you can tell me. But I don't understand how balance sheet would have 3 months or 2 months or 1 month of data. What does it actually mean? Because shouldn't they all be the same? And then some balance sheet metrics would have 1 month and the other one didn't. So my more intuitive is that it's a quarterly statement that's been released. So I just put everything in 3 months. I don't know if anybody can answer that question. That'd be great to know.
Hi, can you hear me?
Yes, we can.
Oh, cool. It's an access a field. So if the value has a 1 month, you can access it with that. But if it doesn't have a 1 month, then you'll need to put in the appropriate period for whatever the data is. So just because there's so many, we don't have the individual periods for each field, but that's something we should add to the to-do list.
But what does it mean that a balance sheet? So in an income statement, for example, earnings, I would understand it's earnings over the last month or over the last 3 months or over the last year. You would expect increasing values, right? So let's say if I want to see 1 year, I would select 12 months. But the balance sheet, isn't it like a snapshot? So what is, let's say, land and improvements on the balance sheet? What will 1 month and 3 months give me different values at a period, at a point in time?
Most of the financial statements will be quarterly. So it'll be the quarterly report, and so it'll only have a 3 month value. The 1 month one will just be null.
Okay.
So it depends on the field that you're looking at. Most of, for example, the price valuation metrics will be monthly.
Okay.
Like PE ratio and that sort of thing.
Awesome. Yeah, that makes sense. Yeah, just for these balance sheet items. Anyway, so the 3 months is what I used as well. All right. And the 12 months, maybe I'll just ask a question. Does it come from the annual statement or just rolling quarterly statements?
It's a good question. I'll have to look it up on Morningstar Docs. I'm not sure.
All right, sure, fair enough. All right, that's all from me.
Cool. Thank you so much, Igor. And then our last presenter will be Jason presenting his strategy. So
Right. Thank you.
take the wheel, Jason.
Hey guys, so I'm Jason. I go to University of Illinois in Chicago right now. Let me share my screen real quick. So today I'm going to be talking about options. Can you guys see my screen?
Yep.
Okay, cool. So earlier, back in July, I made a post where basically, let's say you want to buy a bunch of different equities in, in like a scheduled universe, and you automatically, or you just want to hedge your all your equities with options. Well, I didn't really see an easy way where, like, if you don't know which equities you're necessarily going to get, how could you see how could you hedge them with the options? So I made a post where basically, based on your the different equities which your algorithm selects, you would automatically pull both the put and the call contracts if they were available. And then based on your insight in your alpha model, you would either select the put or the call. And the code's right here. A bunch of people helped me out because, I don't come from a software engineering background. So I definitely had a bunch of bugs. But basically, it fits within the framework, except the option universe and the option alpha are both set up to also work with options. And then the way I kind of set it up in the options alpha is that, okay, maybe it'll actually be better if I describe it the option universe first. So, and a lot of this in the options universe and alpha, I just took from, already created algorithms on QuantConnect's GitHub. So funny thing is, I think I used part of the Greenblatt like magic formula, which you described, Igor, is my part of my universe criteria. But the way it works, just roughly, is it will select your equities based on whatever criteria you might input, and then it'll check. It'll pull an option chain to check to see if there's available puts and calls. And the way I selected the options is I arbitrarily just selected, the strikes to be about 20% away from the current price. And then the expiration, I think it was like 30 to 60 days out. Yeah. So 30 to 60 days out. And then out of that, like, I guess we could say pool of like good options which, we would be happy hedging our equity with, I picked the option with the closest strike and the closest expiration. And my talk today is kind of going to focus on, instead of just like, I guess, picking the nearest strike and expiration, maybe we can use option pricing models to make sure whichever option we pick is fair. Yeah, so in terms of the option universe, then it would just return, the nearest put and the nearest call. And then based on the options, based on whatever our alpha model was, which in this case, it was just a mean reversion one, we would send automatic market orders based on the insights of our equity. So in terms of the option models, so I used this post right here as kind of a jumping point in terms of how to work with the different option models. So the ones that QuantConnect offers are these, and I was just looking through them. And I was having some issues with the black skulls, but I think that there might be, I saw whatchamacallit, I think Derek made a post about something with it returning 0. So I used the Crank Nicholson instead. And like I said, I used this post as a lot of inspiration, but basically, let me pull it up somewhere here. Tabs, oh, right here. So I basically just cloned that post and I ran it with the Crank-Nicholson pricing model, and I got all of the different, you know, each option, the bid, the ask, and then based off that pricing model, I was able to calculate all the Greeks. And then I actually ran it with the binomial. I think it was the binomial tree where there's 3 options. Yeah. So this binomial Trigorgus, I think. And then I ran that one as well. And you know, I was able to I was debugging too when I was running this, but I was able to, you know, calculate the Greeks off what they should be off that pricing model. And then based on, you know, that, I haven't had the ability to integrate, you know, the different, like based off which option pricing model, I haven't been able to integrate that into the algorithm yet. So I was kind of just going to talk about how I'm planning to do it, just because, you know, I've had a couple issues in terms of actually integrating it. I'm thinking the way I was going to do it was right here in the option universe. So instead of just sorting it and pulling, you know, the closest expiration or the closest strike, I'm thinking what I'm going to do is I'm going to input, you know, the calculated Greeks from the different pricing models, and then maybe we can, like for instance, maybe after running all the different pricing models, we see that perhaps delta we think is a predictor for where an option price is going to go, you know, or maybe gamma, or maybe we're aiming to have, you know, a delta neutral portfolio. So we want to calculate all the different deltas of the different options. We could then input that information in order to pick the most, I would say, fairly priced option instead of just the nearest one. So that's kind of where my reasoning was going. So the normal hedging options code does have a back test. It didn't perform that good at all, but that's at all really. It was down like 20%. That's because I really wasn't focusing on making sure, you know, my alpha was predictive. I really wanted to focus on making sure, you know, any like edge cases of, like, for instance, you know, let's say you grab an equity that has, you know, maybe only a couple puts and calls contracts, or maybe what happens if, you know, the insight on your equity flips. I wanted to make sure that all of the edge cases when hedging equities was taken care of. So the back test is right here. And yeah, like I said, it didn't perform good. However, in terms of like fulfilling what like my motivation was, it was able to do it because, you know, I was able to, you know, hedge all of my equities with an option. So I guess that was kind of what I've been working on. It wasn't as well like formulated as everyone else's, but if anyone has any questions or like suggestions, or if I like misspoke about something, let me know. But yeah, I guess moving forward, I'm really just going to focus on, you know, really, I'm thinking there might be some arbitrage between, you know, pricing models for options, you know, perhaps based on where the current price is, and you could like maybe work with some, you know, like average of what the true price should be or whatnot. But yeah, I guess that's what kind of wrapped it up.
Anyone have any questions for Jason's strategy?
Yeah, so I guess if anyone, I could send this link if anyone's interested. I did it like a month or two ago, but I'm still working on it.
Okay, if there's no questions, we do have some time left over. If anybody would like to talk about a strategy they're working on, maybe a problem you've been facing in your research or any research you've done. The floor is yours if you would like to do so.
Igor here. So maybe I have a question. So I didn't read documentation thoroughly enough. I apologize if the question is actually covered there, but I was looking into external data. And specifically, I know that in the included data set, we have 10K filings from Edgar, but we don't have insider trades, which also freely available as part of Edgar. And let's say I have this data set on local, I scraped it myself. I know we can dump CSVs, but does QuantConnect allow to fetch data from like a dynamic database? Like based on the date of like whenever it's trading in the backtest, for example?
Hey, yeah, if it's about SEC data, so I know QuantConnect, you can access SEC data. I experimented with it briefly. Pretty sure it comes in as just one long string, so you may have to clean it up a little bit. But you can, there's some really great examples in documentation. And you know, like you said, yeah, you can import your own external data as well.
Nice. All right, thank you.
I'll share the link for the SEC data or the algorithm for it.
Oh, that'll be great. Thank you.
We are scheduled to go to 7:30, but if nobody has anything that they would like to talk about, one last chance if you would like to talk about something, you know, the floor is yours currently.
I made a post earlier. I don't know if you guys remember. I made a post like a few months ago about like any strategies you guys want. So maybe like if nobody has anything to say, maybe if anyone has any like strategy suggestions for like the strategy library, I'm willing to hear them out. Please don't make it too hard.
Hey, so yeah, I guess I'll share my background if no one was gonna share a strategy. So I'm at UIC right now. I'm a math major. I'm actually roommates with or flatmates with Jovad. So we both started working on QuantConnect like back in like, I think it was pretty involved in like March. And then like overall summer I was on QuantConnect a lot, but it really like helped me learn a bunch. And yeah, I come from like just a math background. So like like all the coding has been like definitely a process, but it's getting better. And that's kind of why I like really focusing on like pricing formulas. But yeah, if anyone has any like suggestions for that, I'd be like super like down. You could just like Slack me. We could like talk about it.
All right, I can share my background. It's pretty messy actually. Originally by trade, I'm a financial advisor, so I was selling investment mortgages, whatever. Then transitioned more into back office, started doing more coding, but at the same time, I was doing CFA, so a chartered financial analyst. So this is where the interest in fundamental analysis came in. Eventually, with all the coding, transitioned to data science. And this is what I do in present day, but not in the financial industry. Work for a retail grocery chain, actually, doing various optimizations for them. So I guess for me, it's combining my past experience with my present experience, because I have background in both. So seems to be a natural fit. Thanks, Jared.
Thanks. You know, I might as well share some of my background too. Again, I'm flatmates with Jason, and over the summer, we worked a lot on QuantConnect. And originally I was a finance major, so coming into this, it was pretty difficult for me. It was a pretty large learning curve. I learned a lot. And I recently switched over to the data science program at my university with a minor in finance. So yeah, that's kind of a little bit about my background. Yeah.
I got into algorithmic trading because I was losing too much money with manual trading, doing effectively intraday trading, scalping, and then trying to automate that with algorithms, because it was a much better trader than I was.
Out of curiosity, how down was your portfolio? Because that's kind of the reason I got into it too. I was down like 80%.
Yeah, I think I don't know, it was maybe a few $1,000s, but it was huge. It was for me at the time, man, I was living in Chile and it was super cheap rent. I was like, damn it, that's 6 months rent gone. So it was yeah, it was bad. But then it was great because then I could just live in Chile and build algorithms and work on the tech.
Wait, what? Wait, did you trade Chilean stocks?
I don't know what the protocol with Zoom is. Should I leave the video on?
If you really want to, you can.
What do people do? Chilean stocks, no, just started with New Zealand stocks, scraping the bank website in like 2007, and then gave up on that because it was horrible, and then tried to do Australian stocks because there was an API to an Australian brokerage, discount brokerage. And to put this in perspective, with the brokerage in Australia, it was $66 to do 200,000 in volume. So that was, it felt really cheap at the time, but it's really expensive by today's standards. Like you can do that on Interactive Brokers with $1 or, you know, Alpaca for free. So, and then, no, I eventually gave up on that too because I could only scrape 1 day of data at a time. So I had to move to the US markets and download data, and yeah, the rest is history.
Hey, Jared, I have a question for you. So I know you started a different company other than QuantConnect. I'm just kind of wondering, like, what kind of made you merge into QuantConnect, or what happened with the other company, and was there a failure and you learned and now QuantConnect is here, or just kind of your story?
First, it wasn't the other company. Maybe is the fund. Is that what you're thinking of? Was it a fund?
I think so. Yeah.
Yeah. So I started. I've always loved algo trading, but started doing it full time in Chile about 2010, and at the time was doing consulting work for humanitarian stuff. But then, kind of, you know, Chile was cheap. I had good internet. I had a great apartment. I was 27 at the time, and I thought, you know, what the hell, why not? So I just started working on it full time, and then went and raised money from friends and family, and pulled it all in account, and I gave that vehicle a name, Stock Track, and started to send them investor reports of how much money they were losing, and you know, trying to bring in more investors to get above the sort of minimum PDT mark, and then eventually just started doing like 4 or 5 times intraday leverage scalping on volatile stocks, mostly Apple, and was building algorithms and running them for like 2 years full time. And it was basically after a year and a half a year and 3 quarters that I finally had something that was making back all the money I had lost. And then, yeah, I just was trying to figure out what to do next, because I really hated the fundraising process. So like the process of managing the books, sending out account statements, the stress of managing the money and having people's, like, it was friends and family, so it was people that I didn't want to let down, and like they were, if I lost my friend's money, it was quite emotionally loaded. So yeah, I didn't like that part. So that's where QuantConnect came out, and I was like, hey, you know, I built all this tech and there's nothing like it out there in 2011, 2012. So maybe this can be something where we can help other people, and I can, you know, we can, yeah, we didn't really have a plan at that point. It was just cool tech that didn't exist in the world yet. So let's make a website for it and take it from there.
Yeah, it's very impressive, Jared, for sure. Thank you for making it available for everyone.
Now it's not me. Now it's a whole bunch of really smart people from all over the world. So actually, my first version of it, Michael came in and rewrote 80% of it. So there's only a little bit left of my code. What about everybody else? There's a lot of new names and faces and people I've never heard about. Speak up.
Yeah, so my name is Sairaj. I study mathematics and computer science at UIC. I interned as a quantitative analyst for a German company called Capilindo, where I was dealing with a lot of crypto assets and creating an index for them, for the investors. And afterwards, I realized I don't really want to do something that's going to hold on money for long term. I want to make money in the short term. And then that's pretty much what led me to automatic trading. And fun fact, I actually met Jason and Javad at UIC. Another fun fact, we're sitting in the same room right now.
I can see the flag in the background.
Yeah. And yeah, that they pretty much introduced me to QuantConnect, and the journey's been amazing since.
You three should start a hedge fund together.
That's a great idea, Jared.
Roomies, quants, hell yeah.
In 15 years, we'll see a movie on them.
If nobody wants to go, I can go. So, I'm a computer science student at the University of Washington, and I'm part of like the algorithmic trading club at my school. I don't know. I like finance and I like programming, so like thought like quantitative trading kind of combines both of them. And so now I'm interning at QuantConnect and doing stuff.
And fun fact, Sheila?
A fun fact about me?
Sure.
Fun fact?
I know at least one. You're the youngest person in QuantConnect.
Oh yeah, that's a good point. Yeah, I'm 19.
19.
Another fun fact. I don't do anything with COVID, so I can't really. Oh, I like to fold origami. And sometimes I like to collect coins. I guess. Hopefully that's fun.
I guess I can go. So I'm from. I actually started in quantitative psychology. Then I worked for the government of Manitoba, which is where I'm from, in the Department of Department of Families, which is our family services department. I worked as a data analyst. I realized that was kind of my forte. So then I moved into statistics. I'm currently a master's student in statistics at U Waterloo in Canada. And yeah, so I recently, even though I started kind of far off, more in the hypothesis testing kind of realm of things, when I was here, I moved into stochastic processes, and all my courses were taught with quants because they needed it. So I slowly kind of learned a bit more about that kind of area, and it turned out to be my favorite area. So moving into quantitative finance.
Awesome. We're in Manitoba, are you?
Well, I'm from Winnipeg, but currently I'm in Mississauga. I went to, my university physically is in Waterloo, but due to the whole, COVID thing, and just ended up working out better for me and my girlfriend, because we lived together, to live in a bigger place. And Mississauga was kind of just down the road, and that's where we ended up. And I could say at least it's not as cold as Winnipeg.
One of our first people in QuantConnect was from Winnipeg. So I got to know Winnipeg before I knew a lot of the states in America. Yeah.
It's weird. We pop up everywhere.
Yeah.
We never make it known.
Hi guys. Yeah, I can probably go next. So I am a software developer with Amazon. So I have done my CFA level 1. I was going for my CFA level 2, but I sort of decided I want to move into software development itself. So now, yeah, now I am making some good money. So I thought, why not try some of some of the stock business.
Awesome. Can you share what you do on Amazon?
So I'm currently with a team, which is we are basically giving out Amazon's internal customer care to the final to the final customer. So it's like we have our own customer care center. So if you are a company and you want customer care for yourself, we are basically building a software as a service platform for them.
Cool. Awesome. Welcome to QuantConnect.
Thanks. It is awesome watching all of you guys do good work.
Don't worry, none of us know what we're doing.
I'll just go through the GitHub repository probably over next month, and probably I'll start contributing something.
Yeah, one thing that really helped me was the community. Just kind of going there, looking through all the algorithms. Definitely Schiller and Derek's comments really helped in their posts. So definitely go through that.
Sure. Yeah, thanks guys.
Okay, I think that will wrap it up for us today. Like I mentioned before, we are going to try to do these once a month. I am on Slack. We're all on Slack. I'm more than open to suggestion if you want to see something in the next meetup. Any comments, or like I mentioned, if you have any questions about the presenters, they're in Slack as well. So yeah, you guys have a great Thursday. I hope you guys have a happy weekend, and we will see you next time.